In the complex world of finance, portfolio diversification stands as a fundamental strategy that investors employ to mitigate risk while seeking to enhance potential returns. This narrative will deconstruct the concept of diversification, its significance, and practical application for both novice and seasoned investors. Portfolio diversification involves the allocation of financial assets across various categories, including stocks, bonds, mutual funds, real estate, and even alternative investments like commodities and cryptocurrencies. The fundamental principle behind this strategy is risk management. Spreading investments reduces the exposure to the negative performance of a single asset or a group of assets that are highly correlated. By holding a mix of asset classes that have low or negative correlation with each other, the negative performance of some investments can be offset by the positive performance of others. Consider the analogy of an investor who decides to invest solely in technology stocks. While this sector might show growth, it is also subject to volatility and downturns from factors like regulatory changes, technological shifts, or economic recessions. If a significant disruption occurs within this sector, the investor's entire portfolio could suffer. In contrast, if the investor diversifies to include a range of sectors like healthcare, finance, and energy, they can buffer against losses from any single sector by potentially benefiting from gains in others. In practical terms, investors might achieve diversification by employing strategies such as acquiring a mix of domestic and international stocks, varying the size of companies from small to large market capitalizations, or by balancing between growth-oriented and value-oriented stocks. Strategic diversification does not imply spreading investments too thinly or randomly across assets. Effective diversification requires informed decision-making based on the evaluation of market conditions, economic indicators, and individual risk tolerance. It is essential to continuously monitor and adjust the portfolio to reflect changing market dynamics and ensure alignment with the investor's financial goals. In conclusion, portfolio diversification acts not merely as a risk reduction tool, but as a strategic approach that enhances the resilience of investment portfolios amidst market fluctuations. By thoughtfully diversifying, investors position themselves to capture opportunistic growth while protecting against unforeseen market downturns, ultimately fostering financial stability and growth over the long term. Subscribe to the channel to encourage us to continue producing videos like this. Like and comment on upcoming video topics.